Welcome to Millionaire Corner. I'm Kathy Dordick, and I am joined by Gary Rose of Frost, Ruttenberg, and Rothblatt. And we're going to be discussing some tax issues for 2012 as well as going forward in 2013.
Well, FR&R has been around for over 50 years. We have historically served small business owners and high net worth individuals. And from that small start 50 years ago, we've grown to a firm of over 100 employees here in Deerfield, Illinois.
Can you give our viewers kind of a recap of the tax decisions that were made on January 2nd as it relates to them?
On January 2nd, 2013, the President signed the American Taxpayer Relief Act of 2012, which actually gave us a roadmap to what our 2012 and 2013 taxes were going to look like. Many issues were uncertain as we came into New Year's Eve. We really did need a resolution by year end, but fortunately we got it at least within a day or two thereafter. So what could have been a sweeping increase in overall taxes for individuals at all income levels ended up being a much more modest increase for the higher net income, net worth individuals only.
Now, many of our affluent investors were obviously very much so impacted by some of the tax code changes that were included in Obamacare and in that compromise in January. Can you tell us a little bit about what that means for them going forward in 2013?
To set the stage for where we're at for 2013, as I mentioned earlier, rates were going to go up on capital gains, on dividend income, and on ordinary income for nearly all taxpayers filing income tax returns. As a result of the compromise, in the Republicans' party insisted that the president's levels at $250,000 of adjusted gross income were too low and would adversely affect too many people, too many middle income people. The final agreement raised the threshold at which taxpayers are subject to the highest tax rate of 39.6%, only to those taxpayers who filing single over $400,000 in taxable income and married filing joint over $450,000 of taxable income. So again, but for the compromise, that would have affected taxpayers at much lower income levels. As a result, it's limited the number of people affected. We also know that the capital gains rates, which have been at 15% since 2000, long-term capital gain rates have been at 15% since 2001 and through the end of 2012. They were scheduled to go up to 20% for all taxpayers effective January 1st, 2013. Again, as a result of the compromise, which was good news for many of us, only those individuals who have income in excess of $400,000 or $450,000 for those filing joint are subject to the new 20% long-term capital gain rate. So depending on where your overall taxable income is, your rate may have either remained the same at 15% or may go up by 5 percentage points. On ordinary income, as we said, the top rate used to be 35% through the end of 2012. That rate went up to 39.6%, but again, only for individuals with overall taxable income in excess of $400,000 single or $450,000 joint. As you mentioned, though, there's additional tax rate increases that rolled out into the system in 2013 that were never part of the public or political debate. And the reason is they were embedded in the 2010 Affordable Care Act, otherwise known as Obamacare, which was passed over 2 years ago. Because the Supreme Court withheld or upheld the validity of the Obamacare Act, and the Republicans realized they had no opportunity to overhaul it in its entirety, those new taxes, which were part of the Obamacare Act of 2010, are in fact being implemented in 2013, and thus were off the radar screen, but may in fact result in greater additional taxes to high net worth individuals beginning in 2013 than the ordinary income tax rate and the capital gain rates that we just discussed. So what are they? We know that we all pay Social Security tax on our wages and self-employment income at a rate of 6.2% up to the first $112,000, $113,000. Thereafter, we pay 1.45% on all of our earned income beyond that level. And that's on Medicare tax. Because the Medicare tax was already built into the system for wages and self-employment income, the Obamacare healthcare reform said, let's add another 0.9% to that 1.45% tax rate to bring the total Medicare tax that individuals are paying up to 2.35% starting in 2013. This new tax, though, only affects individuals with total income of $200,000 single or $250,000 joint. So unlike the ordinary income tax rate increases, that resulted from the American Taxpayer Relief Act of 2012. The new Medicare tax applies to incomes at lower levels of 200,000 single and 250,000 joint. So on the earned income side, we have a 0.9% increase in Medicare tax. And if you're an employee, you'll just see a lower net check because the employer will begin withholding that extra 0.9% from your wages. If you're self-employed, you'll add the additional 0.9% to your other self-employment tax that you already owed in the past to your regular income tax and pay it all in on quarterly estimates as you have, but just at a higher level. The brand new tax, though, is called the net investment income tax, which is really a Medicare tax on investment income. So this is really revolutionary for the tax code because it's the first time that the United States tax system is actually imposing a Medicare tax, which has historically been a payroll tax, on investment income. So all of our clients who are retired and no longer have earned income of any sort have historically not had any obligation to pay any form of Social Security or Medicare tax going forward because they're living off of their investment income. But now, beginning in 2013, to the extent that they have an income in excess of $200,000 single, $250,000 joint, they'll pay an extra 3.8% Medicare tax, aka tax on net investment income, in addition to whatever their regular income taxes are at the 15% qualified dividend rate, 20% qualified dividend rate, or up to 39.6 ordinary income tax rate. So what's going to happen on the personal return, if somebody really wanted to dig into it, is they would see that their regular income tax probably went up, as we described earlier, as a result of the overall rate structure increase. But in addition, there's going to be a brand new line item called Medicare tax on net investment income at 3.8% for those individuals with investment and overall income above the $200,250 threshold. So that's really revolutionary, and it was most surprising to us as tax professionals that didn't get the type of political attention or public debate that we would have expected. But again, because they were sleeper provisions in healthcare reform, and everybody associated the Affordable Care Act with provisions that cause more Americans to be covered, under the private health insurance system. Nobody except for the high net worth, high net income individuals would have been paying much attention to those 2010 provisions, which conveniently weren't scheduled to roll out for at least 2 years later.